Think about the last time you drove past a warehouse. You probably didn't think much about it. It's just this huge beige box sitting beside a highway. Concrete walls, flat roof, dozens of loading docks, trucks coming in and out. No fancy entrance, no customers. Nothing about it screams, someone is making a fortune here. And yet, some of the biggest real estate businesses in the world are built around these exact buildings. Warehouses. And here's the weird part. Two warehouses can look almost identical from the outside, but one can make its owner millions for decades, while another can become a massive financial headache. So what makes the difference? It's not really the building. It's the deal behind the building. Because a warehouse is basically a long-term bet on one thing. How much will companies be willing to pay for this space years from now? And once you understand that, the entire business starts to make sense. First, you have to build a thing. And warehouses aren't cheap. A basic warehouse shell can cost somewhere around $15 to $30 per square foot. But a modern distribution center is a completely different animal. You need stronger construction, fire suppression, loading equipment, specialized systems, and all the other things a major retailer or logistics company expects. That can push construction costs closer to $100 to $175 per square foot. And then there's the land. You can't just put a massive warehouse in the cheapest piece of land you can find. It needs highways. It needs workers. It needs to be close enough to major population centers to make transportation worthwhile. Then you add engineering, permits, legal costs, financing, and all the other expenses that show up before the first tenant even moves in. So a 100,000 square foot distribution center in a major logistics market can easily turn into a roughly $12 to $14 million project. And that's before you've stored a single box inside. Now, you'd think the hard part is over once the building is finished. It isn't, because building the warehouse is only half the game. The really interesting part is what happens after you sign the lease. Most industrial warehouses use something called a triple net lease, or NNN. The name sounds complicated, but the basic idea is pretty simple. The tenant pays rent, and on top of that, the tenant also covers its share of things like property taxes, insurance, and maintenance. So the landlord doesn't have to run some giant operation inside the building. There's no hotel lobby, no restaurant, no hundreds of employees working for the property owner. The biggest thing the landlord cares about is rent. More specifically, there's one number that can become extremely valuable. The difference between what the tenant is paying and what that same warehouse could rent for today. Here's a simple example. Imagine a company signs a 7-year lease. At the time, warehouse space in that area is going for $7 per square foot. So that's what the tenant agrees to pay. 7 years go by. The city grows. More businesses move in. Demand for warehouse space increases. And now, similar buildings are renting for $10 or even $11. But your tenant is still paying around $7. The building hasn't changed. The loading docks are still the same. The walls are still the same. But suddenly, that lease is incredibly valuable. When a lease expires, the landlord can potentially reset the rent closer to the current market rate. That difference between the old rent and the new market rent is called the mark-to-market gap. And during the industrial boom, some major warehouse landlords had gaps of 40% to 60% on leases that were coming up for renewal. Think about what that means. The landlord doesn't necessarily need to build another warehouse. It doesn't necessarily need to find a completely new customer. Sometimes, it just needs to wait for the lease to expire. That's one of the reasons this business can quietly compound over time. Build the building once, lock in a tenant, collect rent, wait a few years, then potentially reset the rent much higher. But there's another reason warehouse tenants don't just leave whenever the landlord raises the rent. Moving a warehouse is a nightmare. Imagine you're running a distribution center. You got inventory sitting inside, huge racks, forklifts, employees, shipping systems, delivery routes, customer orders. Everything is built around that location. Now imagine someone tells you, okay, we're moving. You'd have to tear everything down, move the inventory, change shipping routes, reorganize staff, update addresses, and hope you don't disrupt the entire supply chain while doing it. That's expensive, really expensive. So even when the landlord raises the rent, staying can sometimes be cheaper than moving. And that gives the landlord something very valuable: pricing power. But this is where the warehouse business gets dangerous, because the exact same thing that can make a warehouse incredibly profitable can also destroy the economics. And that thing is too much supply. During the early 2020s, e-commerce exploded. Companies needed more distribution space. Developers saw what was happening and started building warehouses everywhere. And some didn't even have a tenant lined up. They basically said, "Build it now. Someone will rent it later." For a while, that looked like a great idea. But eventually, demand cooled down. The warehouses didn't disappear. They were still there. And suddenly, you had a lot more warehouse space competing for tenants. That's when the story can completely flip. Remember our $7 rent? If the market rises to $11, the landlord wins. But what if the market goes from $11 down to $9? Now the landlord has a problem. The tenant's old lease might actually be worth more than what the market is willing to pay. So instead of waiting for the lease to expire and celebrating a huge rent increase, the landlord might be sitting there thinking, how do I keep this building occupied? And an empty warehouse is especially painful because the mortgage doesn't care. The building can be empty. The rent can be zero. The loan payment still shows up every month. So let's actually run the numbers. Say you build a 100,000 square foot warehouse. Construction costs $100 per square foot. That's $10 million. You spend another $2 million on land. Now you're at $12 million. Then you add roughly $1.5 million in soft costs. Engineering, permits, legal work, all the boring stuff that somehow costs a lot of money. Your total project cost is now around $13.5 million. Now you find a tenant. They're willing to pay $9.50 per square foot. That's $950,000 in annual base rent. Because it's a triple net lease and the landlord's operating costs are relatively low, let's say around 93% becomes net operating income. That's roughly $883,500 a year. Now here's where real estate gets interesting. Suppose similar warehouses are trading at around a 5% capitalization rate. A property producing $883,500 a year at a 5% cap rate is worth roughly $17.7 million. You spent $13.5 million building it. The finished property is now worth around $4.2 million more than what it cost you to create. And you haven't even increased the rent yet. Now let's add debt. Suppose you borrow 70% of the project cost. That's about $9.45 million. At 7% interest, your annual debt service is roughly $661,500. Take that away from the $883,500 of NOI, and you're left with around $222,000 in year one cash flow. You put about $4.05 million of your own money into the project. So your initial cash-on-cash return is just under 6%. And honestly, that doesn't sound amazing. But here's the part that matters. The lease might have 3% to 4% annual rent increases built into it. And 7 years from now, market rent could potentially be 30%, 40%, or even 50% higher. Your mortgage doesn't suddenly become 50% more expensive, but your potential rental income can rise dramatically. That's where the real estate math starts getting interesting. Now, let's take the exact same building and imagine things go badly. 3 other developers build nearly identical warehouses nearby. Suddenly, there's too much supply. Vacancy rises. Your tenant's lease expires. But instead of rents going up, rents have fallen. Now you don't have a mark-to-market opportunity. You have a vacancy problem. Maybe the building sits empty for 6 months, maybe 9. During that entire time, you're collecting nothing. But that $661,500 annual debt payment, still there. And when you finally find a tenant, you might have to accept less rent than your previous tenant was paying. This is why warehouses aren't as simple as build a big box and collect rent. The location matters. The construction cost matters. The timing matters. The tenant matters. And the lease matters. You can get almost everything right and still get crushed if you build in the wrong market at the wrong time. And that's what makes this business so fascinating. From the outside, a warehouse looks incredibly boring. It's just concrete and steel. But underneath that boring exterior is a business built around long leases, rent increases, leverage, and one very important question. What will this space be worth when the lease comes due? Companies like Prologis have built enormous businesses around this exact model, with roughly 1.2 billion square feet of logistics space owned or managed globally. And thousands of smaller developers are making the same bet on a much smaller scale. If they get the location right, if demand keeps growing, and if rents move higher, that boring beige box can become an extremely valuable asset. But if everyone builds at once, and demand doesn't keep up, that same beige box can become a very expensive problem. So the next time you drive past one of those massive warehouses beside a highway, don't just see an empty building. Think about what's actually happening inside the deal. Someone spent millions to build it. Someone signed a long-term lease. Someone is collecting rent every month. And somewhere in that lease is a bet about what the building will be worth years from now. That's the real business of warehouses. Not boxes, not loading docks. Space. And the money comes from controlling the right space, at the right time, with the right lease. If you made it this far, you probably like seeing how these boring-looking businesses actually make money. Subscribe for more breakdowns like this, and let me know what business we should open up next.